All right, guys, we got to be quiet. I just shut the door of my room because I'm about to tell you something that a lot of people don't want you to hear, okay? Okay. The stock market's going to hit new all-time highs very, very soon. All right. In all seriousness, today I'm going to get into my thesis as to why I believe this is the case. We have a mother of all short squeezes shaping up, and I'll get into that in today's video. If you guys are new here or returning and not yet subscribed, please subscribe down below because we're one of the fastest growing stock market YouTube channels currently, and I know I'm biased, but I'd like to continue that trend. Now, you may be wondering, why would I listen to this random YouTuber that I found as to where the stock market's going to go? And that's a very good question. And in fact, I'm supposed to ask you not to trust me because I'm not a financial advisor. I'm a YouTuber. These are my opinions, my own thoughts, and I came up with my own conclusions. So it's up to you guys to do the same exact thing. Come up with your own opinions, your own thoughts, and your own conclusions about what I'm saying today. I'm not telling you this is fact. This is just my thesis. And all of this being said, I am overdue to be wrong because I've been correct about the stock market since October of 2022, which is when the bear market finally found its bottom. On October 6th, I uploaded a video titled "Stocks Just Bottomed and Nobody Noticed." I like to say that nobody noticed this video because it has less than 1,700 views. If you want to go support it, I know it's a little after the fact, but you can go back and watch this. Click the eye in the top right-hand corner, and you can see my thesis from October of 2022, and it played out to a T. And then fast forward to July, I made a members-exclusive video titled "Why Stocks Will Skyrocket Tomorrow." This video was posted on July 11th of this year, and the basis of it was that I thought the June CPI data would come in way below estimates, and it did, and the stock market did skyrocket the next day. So a lot of my members made a lot of money there. I don't ever encourage anybody to blindly follow what I do, but if you do want my buy and sell alerts along with my analysis and special exclusive videos like this one, special exclusive market calls, hit the join button down below located right next to the subscribe button, or hit my Patreon link in the pinned comment. And then let's fast forward even further. More recently, August 1st, I posted a video. Same sort of deal, only 1,700 views, pretty low. I said stocks are all about to dip. Here's why. And, throughout the month of August, stocks have dipped. They've dipped a lot. So I promise I don't have a crystal ball. I'm just a 22-year-old YouTuber and investor, but I got this one right as well. But even more recently, I uploaded a video just last week titled "The Stock Market Crash is Canceled." Here's why. I uploaded this video on August 24th, and ever since August 24th, the stock market crash has ended, and stocks are skyrocketing again. And I promise I'm not bringing this up in a braggadocious way. That's your vocab word for the day, by the way. But I'm bringing this up to prove that I am overdue to be incorrect, so please do not blindly follow what I say in this video to a T, because I'm more than likely going to be wrong eventually. If it's this video and this call, I don't know, but at some point I'm going to be incorrect. So take everything I say today with a grain of salt. So in my most recent videos, I stated on multiple occasions that I felt the markets were more scared about the above trend economic growth than they were scared about inflation itself. Now, a lot of people didn't agree with that thesis, but Jerome Powell gave me credence to this.
But we are attentive to signs that the economy may not be cooling as expected. So far this year, GDP growth has come in above expectations and above its longer run trend. And recent readings on consumer spending have been especially robust. In addition, after decelerating sharply over the past 18 months, the housing sector is showing signs of picking back up. Additional evidence of persistently above trend growth could put further progress on inflation at risk and could warrant further tightening of monetary policy.
And following those comments and the entire Jackson Hole conference, which was received as very hawkish for a lot of investors, the market rallied on Friday, on Monday, on Tuesday, and now on Wednesday. Over the past 4 trading days, the NASDAQ itself is up more than 5%. Why would this be? For starters, yesterday we got what's called the JOLTS report, which shows job openings and labor turnover. Job openings fell to levels not seen in over 2 years. You can see that in the top chart here. 8.8 million job openings, And the job openings per unemployed worker also fell to 1.5. This is showing the labor market rebalancing and cooling off. To put it simply, this means that the demand for labor is easing, aka the jobs market is cooling off, which means that this above trend economic growth is less likely to continue. Now, it's important to note that, yes, job openings fell. Job openings per unemployed worker fell. And that's a very, very good thing. That means that we're going to avoid seeing an even more hawkish Fed, an even more hawkish Jerome Powell. But economically, this data is still viewed as good, just not great. And as long as we continue to get good but not great economic data, it's going to mean very, very good things for the stock market, because we can sidestep an economy-wide recession, and we can also sidestep a very increasingly hawkish Fed. And then this morning, we got news that the U.S. second quarter GDP growth was revised lower. What did stocks do today? Stocks rallied. The NASDAQ was up 0.56% today. For a lot of people, this is going to be very confusing. GDP growth going down shouldn't be a good thing for businesses in the economy, which means the stock market should go down, right? No, not at all. This is good, but not great news. You see, the second quarter GDP was revised lower, but it was revised down from 2.4% to 2.1%. The economy is still growing at 2.1%, or it grew at 2.1% in the second quarter. That is still very, very good economic growth, but it's no longer great growth. This is good news, but not great news. Exactly what the markets need to see right now. And we even got some more jobs data this morning when the ADP employment report came out. U.S. job growth slowed sharply to 177,000 in August, below expectations. The jobs market is cooling down from this above trend growth. It's simply going back to trend, which again is a very good thing for the stock market moving forward. Now, my thesis for all-time highs happening soon for the stock market is on the basis of the Treasury yields. Right now, the U.S. 10-year Treasury yield is 4.118%, still above 4%, but you can see over the past 5 trading days or so, the 10-year Treasury yield is down from 4.366 to 4.12%. This happened very, very quickly. That is a large change for a 4 or 5 trading day span, and this again is on weaker economic data. I say weaker, but it's not weak economic data. And this is just telltale that the markets were most concerned about above trend economic growth rather than inflation itself. With this weaker than expected or good but not great economic data coming in, the yields have started to fall, which means the markets are no longer pricing in higher for longer interest rates. The markets have been fearing that Jerome Powell would raise rates as a result of a strong economy, not that he would raise rates as a result of inflation going back up to 3 to 4 to 5%. And this data on the screen here, I have heard nobody talk about, but I think it is so important. This is why the 10-year Treasury yield fell so quickly. We have net 800,000 contracts of $100,000 of face value shorting the 10-year Treasury. This was as of August 15th, which if we go back on August 15th, we can see that the 10-year Treasury yield was 4.3%. At 4.3%, there was literally a record amount of short sellers shorting the 10-year Treasury, basically meaning that they thought the 10-year Treasury yield would keep going higher and higher and higher for a lot longer. And all of a sudden, when we get less good economic data, the Treasury yield falls because people are buying the Treasury yield and the stock market rallies 5% in 5 trading days. This is a short squeeze. But what's even more exciting is there is a lot more short to squeeze. Coming down from 4.32% to 4.11, 4.12% is a lot for 4 or 5 trading days. But this Treasury yield can come down a lot more, especially if the data keeps coming in Bull's favor, which, according to all the data we have, looks like is going to be the case. At no point in history have we even come close to this level of short interest in the U.S. 10-year Treasury. So what does this mean? If you've been following my channel, you would know that my personal portfolio is positioned heavily into small caps and mid caps, plus PayPal. And this is pretty simple. Right now, the S&P 500 large caps, according to historical data, they are trading above trend. They have a forward PE ratio on average of 18.9. This is above historical averages. For mid caps, it's a much different story. Right now, the forward PE average for mid caps in the S&P 400 is 13.9. 13.9 is very, very low. That is very low basically no matter what time period you look at other than 2008 and 2009. And then small caps in particular. Man, there's a huge opportunity with small cap companies. I don't know at what point small caps will start to lead, but I know they will because right now the average forward PE ratio on small caps is 13.7. Literally, if we go back forever in history, this is as low of forward PE ratios we've ever had on small cap companies. If Treasury yields continue to fall, we're going to see expansion in multiples of companies, specifically the most risky companies that need access to cheap debt, which are small caps and mid cap companies, right? So that's why I positioned my portfolio in this way. Now, if you come back tomorrow, I'll be making a video where I show you a few of the small cap or mid cap companies that I've been buying. So make sure again that you're subscribed down below if you're new here or returning and not yet subscribed. With that, have a great rest of your day. Stay blessed. Keep 10 toes to the ground and your chin up. Peace out.